Sure. First of all, thank you for having me. We indeed had a record year last year of 124 million visitors visiting our projects, which is incredibly exciting. I think it is proof that the tenant mix that we're providing and the relevance to what the Saudi consumer wants, it's resonating with the Saudi consumer. Thus far this year, our footfall numbers are holding up in comparison to last year. Our occupancy is doing well thus far. You know, we're coming off a really strong year with top line growth, cost control, as well as an increase in the valuation of our properties, the existing properties. So I believe the mix of the results from 23, the strategic vision and pillars that we have in place for the company should take us comfortably into 2024.
Yeah, so the revenues, the revenues growth was around 4%, while the net profit growth was near to 50%. So most of the net profit came from the sales of non-essential assets. So I'd like to ask you about this program of selling the non-essential assets. What do you expect from this program? Where did you reach so far? And what are you expecting in 2024 from this program?
Great. So you're correct. We had an extraordinary result in our net profit for 2023. But it's also revenue growth, it's cost control. It is part of the sales of this non-core asset sale program, which I'll discuss in a minute, but also fair, gains in the valuation of our existing assets, which is, I think, important to highlight as well. But in terms of the non-core asset sale program, in Q4 22, we put together a program of non-strategic land, non-strategic assets that is valued at about $2 billion. Thus far to today, we've already unlocked 1.1 billion of proceeds from that sales program, and we have approximately 800 to 900 million left, which we should be able to dispose of hopefully in the next 12 to 18 months. The latest sale that we did was Sahara Plaza, which is in Riyadh. It's the first center we ever opened. It's not the kind of center that we would open today, but it's sitting in a fantastic piece of land. We're only in the business of building and operating shopping centers, so it was a prime example of a non-strategic asset that could be of a better and higher use to another developer.
Speaking about the new malls, you've inaugurated UWalk in 2023. How will it reflect on your revenues and on your bottom line?
Sure. Well, look, any new asset, once it stabilizes, is always a positive net effect. Not always, but most of the time, a positive net effect on revenue and bottom line. UWalk Jeddah should be no exception to that. We grand opened UWalk Jeddah in February of 2024, so only about a month and a half ago. And it has pre-let levels already of 80%, so we believe it's going to stabilize actually faster than the normal stabilization period, which is usually 2.5 to 3 years. So we believe it's going to come online even faster. In addition to that, we've got the 2 flagships that we are building, one in Riyadh and one in Jeddah. They are the Izayarات projects. They are projects that have a scale and will have elements that the country hasn't seen yet. They're both scheduled to come online in the second half of 2025.
So you're expecting in the second half of this year. We're talking about Jawhara Riyadh and Jawhara Jeddah. Both
for the second half of 2025, not 24.
In 2025. So the expected revenues will be in 2026.
Correct.
Yeah. Okay.
Correct.
And you have Jawhara Dammam or Khobar.
Khobar, exactly. So we just received the construction permits for Jawhara Khobar, and it's in the planning and design phase now. But in our pipeline, we've got 6 specific assets in our pipeline, these 3 Jawhara projects and 3 additional lifestyle destination centers, all to be completed and come online by 2027, which will add over 40% of an incremental increase in our GLA. So it's significant.
Okay. Now with occupancy levels of around 92% and record visitation numbers, are there any plans to adjust the current rental rates within your malls?
But that's always a focus. So we had entered 2023 and we're entering 2024 with a plan. It was a premeditated plan to do something that we're calling proactive churn. So it's going above and beyond just renewing through the existing contracts as well as through the terminations that you receive. We're really scrutinizing the portfolio. We're looking at our tenant mix to ensure that we're delivering the right balance for the Saudi consumer. But in addition, we're also coming off of we're in a post-COVID environment. So it allows us the opportunity to ensure that we're getting better pricing now, that we're having better tenant mix, and that we're getting a stronger covenant with those tenants to mitigate the risk. So that is our focus. And again, with that footfall record in 2023, I believe that what we're doing is working.
So we might expect some increase in the rental rates.
Yes, I believe so. That's our goal.
Okay. Fair for the investors. I would like to ask about the Sukuk offering totaling 5.25 billion riyals. How do you intend to allocate these funds and what impact will it have on your gearing ratio and your liquidity? Sure.
So the 5.25 billion, it was a refinancing of existing debt. It is a fantastic result in that it gave us a bit more headroom in terms of a bit more liquidity and better terms and better rates. In addition, it also included a sustainability-linked loan. So it has initiatives and KPIs attached to it, which will lower the rate even further, pending we hit those KPIs, such as lowering our carbon footprint, connecting more of the assets to the grid, and there's not that many that are off the grid, as well as a diversity and inclusion connection point with adding more women in leadership positions. The Sukuk, so we had a Sukuk program that was expiring in November 2024, and we were successfully able to refinance that again also in February. It was a $500 million Sukuk that was refinanced in February, and the international investor market really stepped up, as well as the regional and local Saudi market. We were over three times oversubscribed just for that Sukuk. So we consider it a great success. That is a net neutral debt effect because it's refinancing the existing Sukuk that exists already. But because of the success of that Sukuk refi, we tapped into the market one more time in early March, and we're able to raise another 100 million US, which is all going to enhance our balance sheet, help with our liquidity, and also, help us with our growth plans and the capital expenditure attached to it.
My final question about the dividend policy. Yes. You've announced a new policy today, offering 37.5 halala per share on a quarterly basis. So what prompted this change in the dividend policy?
It's not necessarily a change. I think it's just a timing change more than anything else. It's maintaining historic dividend payout. It's still subject to General Assembly approval. But, there's not really a fundamental change, actually, in the dividend policy.
Okay. So what payout ratio does it imply?
The 1.5, which is our historic benchmark.